Good evening, viewer. I'm a UK and a cross-border taxation specialist. Today, I'm here to explain beneficial loan charges and its tax implication. So, a beneficial loan charges. So, this topic highly tested in ACCA, ACA, and CTA exam. Also useful for employer who provide or who lend money to employee and charge lower interest rate than the market rate. So a beneficial loan is the one if an employer lend money to their employee or to its employee, then charging lower than the prescribed rate. So prescribed rate is the one published on HMRC website. It's been taken on the basis of the current market rate or the central bank rate. So if it's lower than that, so this will result in a cash equivalent benefits. So this will have a tax implication. In exam, you will face this kind of question often. So let's see how you're going to tackle this in your exam. There's further to remember there are rules. So sometimes there will be a case if the loan has been arranged through a parent company or subsidiary company or through future employer. So this will also come under this. So a loan in the form of any credit, not just cash. It can also include alternative finance arrangement. If the loan is made to two or more employees jointly, the cash equivalent must be split between them in just and reasonable way. So the purpose of this is like just to stop the dirty practices. What will happen is because of the multinational environment where an employer has many subsidiaries or multinational company has many subsidiaries, so they would arrange a loan to another company. So as long as this loan is arranged by the reason of employment, so this loan would fall in that category. And then if the employer charging lower interest than the market, this would result in a beneficial loan charges. There's exemption if the loan is 10,000 or less. However, this would apply on aggregate basis. So on aggregate basis is, for example, if one loan is 8,000 and then there's another loan given which is 7,000. So if you aggregate them, would be 15,000. So the 10,000 exemption will not apply. So the 10,000 exemption apply if the aggregate of all loan throughout the year is 10,000 or less. Ordinary commercial loan by banks and the building society to their employee on ordinary commercial term will not result in taxable benefit. For instance, and the banks usually give the discount on mortgages or the loan to their employee. So obviously this can be ignored as well. Now, exemption. And then another loan would be like if it's less than 1,000 and it's given to employee and the employee spend within 6 months and the employee keep bring the receipt to the employer. For example, if they spend it, they show the receipt to the employer. So then this loan would be exempt as well. And any loan for qualifying reason. So for qualifying reason, there's a big definition on the HMRC website. However, where the interest on the loan would be qualified for tax relief if the employee had actually paid the interest in question. So the loan will not be treated as a taxable cheap loan. Now, in exam, highly tested, so they will be given to you a scenario and they will ask you to calculate the cash equivalent. So usually two methods. One is averaging method, the other one will be strict method. So for compliance purpose, the averaging method is sufficient. However, the HMRC or the taxpayer can insist on using the strict method. HMRC would insist if this would result in additional tax charge. Obviously, they would like to have more money. So what is average method? So under this method, if you get an exam, it's just be focused. So what happened is the way it's work is take the figure at the 6th of April and then add this figure and the outstanding figure at the end of the year on the 5th of April and the result will be divided by 2. Sometime what will happen is maybe at 6th of April there was nothing outstanding, and then at the end of the year, remember the financial year in the UK start on 6th of April and on 5th of April. So if there was no loan outstanding at the start of the year and nothing outstanding at the end of the year, so then the way you need to do is any loan provided during the year, and then you take, for example, on 1st of August, there was a loan of 50K. So take that figure, 50K. And then before the end of the year, say on 28th of February, the loan was left only 20,000. 30,000 has been paid. So then 50 plus 20, because 20 left at that date. Or if the loan has fully repaid, so then take that repaid amount. You see, like if the loan has been paid in full, then we add the amount of the loan at the point it was repaid. Okay, so be careful. In exam, the question can be turned upside down, but if you know the rules, it will be straightforward. So add them up, divide by 2, multiply by average ORI rate, which will ORI rate will be given to you in exam. If the employee makes some contribution, don't forget to deduct those contribution in calculating the cash equivalent benefits. Average method. So for example, Simon borrowed 50,000 from his employer in 2020. The loan is interest free, so obviously is a beneficial loan because Simon does not pay interest. So if Simon would pay full interest, no beneficial loan. Simon is not required to make any contribution. Simon repaid 10,000, so 40K is still outstanding, or 40,000 still outstanding. So in this case, 50,000 at the start of the year, 40,000 at the end of the year outstanding. Add them up, divide by 2, so this would and multiply by the ORI rate. This will be given to you in exam, this ORI rate in exam, sometime in the question, sometime in tax, usually in tax table, and sometime during the question they can give to you. Strict method. For strict method is usually calculated based on daily or monthly basis. Both HMRC and the taxpayer have the right to insist that the strict method is used. HMRC only insists if this results in additional tax benefit. Strict method. Take the previous example. Simon, which borrowed like 50,000 and the loan is interest free. Simon is not required to make any contribution. Simon repaid 10,000, so 40,000 still outstanding. So obviously 50,000 were outstanding for 7 months. So of April, May, June, July, August, September, October. So you need to make proportion. And then 40,000, because 10,000 has been repaid. So the 40,000 remain outstanding for the next 5 months. So that is November, December, January, February, March. Okay. So in this case, you don't need to take the 6th April, 5th of April. Just do it like a monthly basis. There are 12 months. So taxable benefit will be like 1375. The ORI rate will be given to you in exam. Replacement loan. Usually, if employment-related loan is replaced by another employment, it's just all this done because the employer doing these tricks just to avoid the charges. For example, if an employment-related loan is replaced by another employment-related loan, both loans are treated as they were single loan for the purpose of calculating the taxable benefit when using the averaging method. So the same treatment would apply, but this one is more complicated. What will happen is if employment-related loan is replaced with a non-employment-related loan, which in turn replaced by a new employment-related loan from the same employer or its connected employer within the same tax year or within 40 days following the end of the year. So what's happened is these are just the employer playing all these tricks. They would arrange one employment loan and then they would arrange a non-employment loan. So just to clear up the employment loan. So when the employment loan has been paid, sometimes the employer would wait for the end of the year. So when the year is finished, so just to make sure, like to make it visible, like that nothing outstanding, and then after 40 days or after 10 days, they were like, for example, after 6th of April, they 5th of April they will arrange another loan. So just that, but HMRC said now if they introduce this 40 days following the end of the tax year, so to catch this kind of arrangement. So be careful. The above would also apply if the employee changed his employment to the new employment, and the new employment still with the same employer, or with an employer connected with the original employer. What's happened is if you work in a finance department and then you've been promoted as an auditor, or because of the multinational environment, so there will be like usually a multinational company have several subsidiary, and they send you from subsidiary A to B. So for instance, like if you work with the PwC, so PwC have several businesses, compliance, planning, tax, audit. So this rule would be for those kind of for those employee who's switching the jobs, but with the same employer. Okay, so be vigilant as well. And usually examiner can test you on this one as well. Loan to participate in the closed company. A closed company is, what is closed company? Is a company owned by 5 or less than 5 participator, or any number of director who is also a participator. So participator is the one who own 5% or more share holding of that company, or share capital of the company. So the rule is this topic usually tested in corporation tax, highly tested in corporation tax. However, it's also related to the employment tax. If a company has a accounting period end, say for example 31st December, and they had the loan to one of its director who is also a participator, and the loan remain outstanding after 9 months of the end of the accounting period. For example, the accounting period end 31st of December, assume it, and the loan remains still outstanding as of 1st of October 2023. So the company would pay charges called S455 charges also, and the rate is 32.5%. And then when the director reimbursed the money to the company, then the HMRC would reimburse the charges. So it's very simple. Loan release or written off. If an employee took a loan from the company and then the employer released that loan, so that would be treated as earning of the employee. Simple. An exception would be is a release following the death of employee. If an employee passed away and he had outstanding or she has outstanding loan, so there's an exception to this. It's not chargeable as earning. A further exception would be if the company is a closed company. If a company is a closed company and one of its director and he's also a participator, and then the company lend the money to him, and then subsequently release the loan, and just write it off. So this would be treated as a dividend in the hand of the. So the director would declare this as a dividend on their tax return. So again, any benefit, either the car benefit or the loan benefit or the voucher benefit, must be reported on P11D form. So what is P11D form? P11D form is a form which will have the employee detail, full name, date of birth, national insurance, and address. So from there, the HMRC would understand that the employee received those benefits. So the HMRC would seek the employee for additional tax. The employer would pay any additional would pay class 1A NI, which is called employer NI, by 22nd. So the deadline for submitting P11D is 6th of July, and the employer will need to pay class 1A NI by 22nd of July. So that is like 15 days or 16 days period. Okay. The reason for telling you this is because the examiner gets happy, or they get more excited when you put a small point. Like, it's very easy to calculate the loan charges, but it's very good to understand what are the exemptions, what are the arrangement the employer using, and how you are well aware of the environment, of the tax environment, and what is the reporting requirement, and then the benefit is subject to employee NI? No, this benefit is only subject to employer NI. Is there any income tax, additional income tax on employee? Yes, there is. So when you write all the small points, the examiner get happy sometimes from tax planning point of view. So once you have more knowledge, you can take over and you can keep writing, so instead of keep quiet. If you have any queries, drop me a line or two, okay, and I'll get back to you. You can subscribe to my channel if you feel like. I will be making more videos on corporation tax, even with the employment taxes, because it's too wide, and I will cover more topic like exam benefits. And so you make sure you're well aware of any exemption, so you don't need to waste time on calculating if there's some exemption, if there's exemption on that benefit. Thanks for watching. Good night.